Hello and welcome to Alphabet or Google Q3 update and analysis video. In this video, we will know the reason why the stock tanked to about $83 on November 3rd or right after the release of the third quarter results. And as usual, I want to remind you that this video is not a financial advice and is for entertainment purposes only. So we will do two things here. First, we will compare 2022 Q3 results with the previous Q3 reports for the past few years. Then we will compare it to the 2022 forecast that we did in the last analysis video. So maybe it's a good idea to watch that video. I will put a link to the annual analysis video in the description box below. You're looking at the 10Q report for the third quarter filed with the SEC on October 26. And I want to mention that in this report, the company provides 3 months results for Q3 and provide the results for the first 9 months of 2022. So we will use the results for the first 9 months in this analysis because it's roughly about 75% of 2022 results. So in this video, I have financial information from all three financial statements, the income statement, the balance sheet statement, and the statement of cash flow for the first 9 months that ended on September 30th. And I made these graphs to clearly show the results. We can see that the revenue growth is there, and the cost of revenue and operating costs are growing naturally with the revenue, so we should be satisfied with that. But the net income and the free cash flow didn't grow as much as the revenue, especially since the expenses growth is very normal. So there must be something else causing the net income and free cash flow to go down. After analyzing the financial statements, it seems that Google is having a huge loss from equity and debt securities. And this loss is shown in the income statement as other income or expense net. And as you can see in this graph, so far in 2022, Alphabet has about 2.5 billion losses from equity and debt securities, while in the previous years, the company had gains. For example, in the first 9 months of prior year, the company had about 9.5 billion gains from equity and debt securities. So when we compare this item in the current year and prior year, we see a difference of 9.5 plus 2.5 billion, which adds up to 12 billion. And that is the difference between the net income in the current year and the prior year for the first 9 months. At the same time, the good thing we learned from this report is that Alphabet is continuing to repurchase its shares, as we can see in this graph, which, as we always say, is something very good for the remaining shareholders because in the future years, they will have a bigger earning per share and free cash flow per share. Now, let's compare the analysis that we did in the Intrinsic Valuation video to the actual results for the first 9 months in 2022. And to do that, I'm comparing only 75% of the forecast numbers because the results that we have is for 3 out of 4 quarters or 9 out of 12 months, which is about 75% of the year. So as we can see the revenue, the forecast was very accurate because Alphabet did about 1% more than the revenue forecast. Similar thing to the outstanding shares, the company actually did better than the forecast by about 52 million shares. But the company missed the free cash flow to revenue ratio because we expected it to be 23% of the revenue, but so far, the company was only able to make about 21% of the revenue as a free cash flow, which of course did hurt the free cash flow and the free cash flow per share, and Alphabet only was able to meet 94% of our free cash flow forecast. So for the free cash flow per share, they made $3.40 instead of $3.62, which is about 22 cents less than expected or about 6% less than expected. And if we keep the same return on investment percentage, then the updated intrinsic value of the stock is $90.61, which is about $2.02 lower than our initial valuation. And this is why the stock price tanked to about $83 on November 3rd. In other words, poor performance in one item, that is the loss on equity and debt securities, caused net income and free cash flow to be less than expected, which caused a change in the intrinsic valuation that caused a sell-off. And with that is the end of this video. Many thanks for those who subscribed recently to the channel. Please subscribe and like this video.